Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. I hope you're all having a fantastic Thursday. So far, this is going to be your daily cryptocurrency market update, and we're going to be focusing really on one topic specifically. We will look at the charts, we'll look at Bitcoin, we'll look a little bit at the dollar, which is of great importance right now, and the yields. And really the main topic of this video that I want to discuss is interest rates and where they're going. This is something that we've been banging on about, certainly for the month of February, and we're now seeing this kind of repricing for markets in terms of rates being implied to go a lot higher, continuing in March. And this is a weight around the risk on asset classes neck. If you are in risk assets, you need to understand what drives them and what is driving them, and that is liquidity. And liquidity right now is essentially controlled by the central banks around the world, and they are at the behest of inflation. So you need to understand macroeconomic data to really work out where you're going as a space. Now, I think there's a tremendous opportunity with the cryptocurrency market in the fact that it is still in its infancy, it's still unregulated, and all that is still to come, and it's actually going to propel it into the big leagues. But there's going to be growing pains with that, and we've seen throughout all of last year that we were really at the behest of external markets. We're in very much correlation with the dollar, with the stock market. And there will come a day when we break free from that. And I think it's going to come with regulations, because that's going to take this space from a $1 trillion market cap into the tens of trillions of dollars. But for now, we need to really pay attention to the macro. And this is what we banged on about throughout February. We showed you a number of charts where you actually got rates getting priced in higher due to stickier inflationary data, meaning that the Fed was going to have to be tougher for longer. However, I think the Fed's very much in a corner. And what we've got now, and what we've seen continue, is with hotter inflationary data, the Fed are continuing, and the predictions for where rates are going are continuing to climb, yields are climbing, and thus, risk is kind of scared, if that makes sense, of all of this. So this month, we've got the CPI, which I believe is on the 14th. So that is 12 days away. Have I got that right? Yeah, 12 days away. Depending on when you're watching this video, if you're watching it on the 2nd or the 3rd, which is the date today. And this is going to be determining, because if you get a lower print, markets will appreciate this, and then you'll get this unadjusting, or I should say readjusting of rates going up and implied for higher for longer. You'll get that come back down. And markets will likely benefit from that. If that takes place, if it comes out higher or hotter, then you're likely going to see continuation in terms of implied rates. CME Fed Watch Tool is a great thing to watch, because in my opinion, they're only going to do a 25 basis points. I don't think one swallow does a summer make. But you now have 30% of the market looking at 50 basis points in the March meeting, which I think is the 22nd of March. You guys understand this. I know it seems boring. I know it seems tedious. But if you can understand the game of liquidity, and you can understand the sort of macroeconomic slant that the cryptocurrency market has to endure, or whipping that the cryptocurrency market has to endure, you will do very well. Not just investing in crypto, but markets generally. It's a very, very standard thing that if liquidity is free flowing and we have QE and zero rates and everything's happy, markets do well. And for the sort of reasonings behind what a very sort of accommodating policy does. But when it's a very restrictive policy, and this is what got us out of the markets last year, the second Jerome Powell said we are going to try and bring demand in line with supply, and we're going to do that through killing demand. All you need to know, because that translates over to all markets in the same way that QE does. So let's start on the first thing. It's so important. We've got quite a bit to go through. We're going to look at Euro data that came in today, which actually sees inflation softening. So is there a bit of a precursor into maybe the next CPI print that we get? We'll talk about it. This was a really good tweet from the Cobesis letter. And he goes on to say, this is incredible. Market futures now see 4 rate hikes as the base case. So previously to this, I think rates were going just above 5%. Remember, we're at 4.75 now. So they were only seeing 1 or maybe 2 rate hikes. They're now looking at a base case So their most probable case of 4. Okay. There is currently a 40% chance rates rise to 5.75 by July. So March, May. So in the next, so what we got a meeting on March, meeting in May. So we've got 3 more meetings. They see the Fed going a whole 1 point in the next 3 meetings. So that would mean a 50, a 25, and a 25. Or a, 33 bips, 33 bips, 33, whatever. But they essentially say there's a 40% chance of rates getting to a whole point ahead of where they're at and going near to 6%. Remember, we've seen people betting on this already in terms of the speculative derivatives markets. So there is now a 13% chance that rates rise to 6% or higher. Just 1 month ago, odds of rates rising above 5.5 were at 0. This is the theme that we've seen since this, with this sticky inflation, and there's a lot of markets are scared right now because, like Mike Wilson said, there's almost this death zone, and he was referring to Mount Everest's death zone, where you're at this pretty high altitude point. Stocks have rallied really well, but the real question is, have they prematurely done this? And for myself, for example, we put money back into the market in January. One thing you've got to be as an investor is open to both sides of the stories, looking at both cases, and then finding merits in both of them and picking the one that has more merits and a higher chance of playing out. Now, I think crypto is probably going to do quite well. And we said this on the start of the year. In the next 3 to 6 months, we think crypto is going to do well. Okay? Potentially going on longer, but we'll see where we're at in 6 months' time. It's quite a way to predict down the line. And I still do think that. I think crypto could climb this wall of worry. But you do have this noose around your neck, which is the macro. He then goes on to say, buckle up. The Fed and market expectations are finally pivoting from hawkish to more hawkish. Inflation is back on the rise. We've only had one inflationary sort of data that suggests this, by the way. So one swallow does not a summer make. People love to jump the gun and be dramatic. I'm not suggesting that this individual is doing that, but let's get a couple more prints under our belt before we can say inflation's back on the rise. Following us at to receive, so on. We're tracking the Fed up and coming policies. So it's interesting. And this is meeting probabilities, and it's looking at where we're going at. We've looked at this previously. There's now a higher chance. I think the last time we looked at this, it was about 20-something%. It's now shot up to 30 in terms of the Fed doing a 50. So you're very much setting the stage for some explosive price action this month. You've also got a load of unlocks in the crypto space. We've got the Shanghai upgrade set to take place this month, which will unlock 16 million Ethereum. You've got a load of token unlocks from other tokens. It's going to be a bloody interesting month. It's going to be a volatile one. And it's a volatile one, actually, at this point of resistance that we're trying to pierce through, not just for Bitcoin, but for altcoins as well. You often get volatility before you either break or slam back down. And this is what we're going to experience. And this is March is just going to be a whirlwind of a month. Nura is first bank to call for a 50 basis point hike in March. In the past year, Japanese bank Nora has been a penchant for making several headline gribbling outlier predictions about the Fed. In June, Nora was the first bank to call for 75 basis points, and they essentially were right on that. So they're essentially saying expect a 50 bips hike in March, followed by a 25 in May and June. So that would get you to your, in May and June, March, April, May. So that, okay, I don't know what's going on. They're doing like an intro on. As persistent inflation drives the Fed to hawkish. So if we continue to get persistent inflation, this is the path that I think we're on. I think the Fed's going to continue to be tough. And I think the Fed are running out of runway in terms of being tough. Already got Yellen going, we need to up the debt ceiling. We can't, we're going to up the debt ceiling or we're going to default. They're going to up the debt ceiling, by the way. The debt ceiling is not a ceiling. It's an open rooftop bar with all you can eat, buffet 24/7 and a free bar, basically. But this is what this is all about right now. This is what markets are all about right now. This is what crypto is all about, being a speculative asset class. This is what the stock market's about. This is what the dollar's about. This is what the yield's about. It's all about inflation and what the Fed are doing. And we have seen today Eurozone inflation softens to 8.5 in February as ECB signal interest rates hiking is not over. So the main question you got to ask yourself is, have markets sufficiently priced in the damage that rate hikes are going to do? Take the dollar off for a second. Have they sold off enough? Was this enough? But the interesting thing is, this rallied on rates maybe topping out and not going past 5.5%. Well, now we've got them coming in at nearly bloody 6, So is there another readjusting that needs to take place? And then you've got to say, well, actually, if we go up to 6%, is there a lot more risk of something breaking in the yield curve playing out? It's a 3D chess game right now. So we bought crypto. We're happy to hold that crypto. If you want to find out about what I'm buying, what my strategy is, what I'm looking at, feel free to join the Patreon. I'm not pushing it on anyone. We only want people that want to be there and want to take their investment journey to that next level, and become part of a community that's also focused on doing that. But, there's a lot you've got to weigh up right now. And we've always said, just because we have a position in the market, we're not opposed to looking at both arguments, the bear and the bull case. Now, I'm sticking with the bull case, which is the stance that we took on January. We've been right so far. We'll see if we do indeed continue to be right. And really, one thing that I'm watching, which I had up, which I've moved from, is the 10-year US bond yields. This typically leads the dollar, and this has gone significantly higher. So is the dollar going to push higher? We'll see. And the yields. I want these to roll for risk to be validated. Okay? I want the dollar to roll for risk to have a good time. We did look at the structure. We did give an update forming this here. So we said actually dollar looks a bit weak. It's sold off since. So these are the main things that I'm watching. And crypto, unfortunately, is still very much at the behest. Now, this is what we're watching. We're really just looking for a right shoulder to form here, whether it's formed at the 0.786 or whether it's still got lower to go. We'll see. Now, whether it needs to come down to the 618, many altcoins are there, or whether it needs to come down to the 0.5. We wouldn't want to see 0.5 really ran, and we certainly wouldn't want to see this left shoulder ran. So this is still the play for me. We're going to update you every single day on this channel in regards to what we're looking at, where we're going. We'll keep you up to date on the inflationary data and what this is kind of predicting. Right now, you have markets predicting a more higher Fed. You get that lower print, they change. You get the 25 basis points, they're going to change. And you're actually going to see a real rally come off the back end of that. So markets right now are either set to dump pretty hard and get confirmation that the Fed is going to be extremely aggressive and continue to do that, or you're going to get validation that the market's going to absolutely fly. And I guarantee you can come and break this 25K range. You'll be at 30 before you know it. Because the volume between this is very light volume, very inefficient price action that you will fill within days. And providing that we get the right data that we need for the bull case, markets are going to fly. Going into when this data starts to hit, certainly with the CPI. But this is going to be a big, big day and expect volatility around it. We'll see where markets are going into that. On that note, guys, I'm going to love and leave you. If you enjoyed the content, like, always appreciate it as a comment, and I'll see you all in the next YouTube video. Thanks a lot for watching, ladies and gents.